So what if the secret to building lasting wealth isn't a flawless mathematical formula,
Right.
but rather this messy, overlapping strategy that looks a lot like, I don't know, ordering two desserts at dinner just because you want to?
I love that analogy.
Right. Because usually when we analyze personal finance, we kind of expect this pristine precision. You map out the exact risk to reward ratios, you locate the mathematical optimum on some chart, and you construct a portfolio that supposedly just stands flawless forever.
Yeah, but I mean, it is the ultimate illusion of textbook finance.
Totally.
Modern portfolio theory loves to present investing as this clean mathematical absolute. Like,
Yeah.
just find the perfect algorithmic balance, strip out all of your human emotion, and simply let the spreadsheet do the work over 30 years.
Which sounds great on paper.
Oh, it's comforting, for
Yeah.
sure. It's comforting to think we can just optimize our way out of risk.
But the moment you step into the real world, that pristine blueprint just gets covered in coffee stains. You face recessions, sudden inflation, global supply chain shocks.
And your own panic.
Yes, your own panic. It turns out the actual landscape of building wealth over a lifetime is incredibly messy. And that brings us to the mission for today's deep dive.
We are stripping away the academic theory today.
Exactly. We are taking a look under the hood of a highly opinionated, real-world investment structure. We're pulling directly from the audiobook The Leaking Pound, How to Build Your Wealth, and the Mystery of Money That Quietly Disappears by Gregory Scola.
Such a good title.
It really is. And specifically, we're dissecting Chapter 8, Part 5, which is titled Putting It Together, My Portfolio.
And I have to say, this specific excerpt is a remarkably refreshing departure from standard advisory literature.
Oh, completely.
Because instead of offering another abstract theory, Scola simply opens his own books. He provides this, granular snapshot of his exact holdings at the start of the year 2026.
And to set the parameters right up front for you listening, the goal isn't for you to blindly copy his positions. Scola states that explicitly.
Right, don't just copy-paste this.
Yeah, the mission here is to reverse engineer the underlying architecture of his long-term strategy. And it's a strategy fundamentally fueled by the grounded, kind of unglamorous habit of regular monthly contributions.
And because the mechanics of steady wealth building matter way more than the specific ticker symbols.
Yes.
He's sharing this portfolio not as a flawless masterpiece, but as a functional framework. Because, observing how a real practitioner navigates overlapping risks is infinitely more valuable than reading a sanitized academic paper.
Okay, let's unpack this because looking at theoretical financial advice usually feels like scrolling through one of those manicured recipe blogs.
Oh, with the perfect lighting.
Right. The lighting is pristine, every ingredient is pre-measured in a tiny glass bowl, and there isn't a speck of flour on the counter.
Nobody actually cooks like that.
No, but Scola's approach is entirely different. It's the equivalent of walking into a seasoned chef's actual kitchen at midnight to see what they throw together to feed themselves when the cameras are off.
It's highly functional.
It is, but I do have to push back on the premise for just a second here.
Sure.
We are analyzing a single snapshot of someone's investments from early 2026, and markets are relentlessly dynamic. Isn't examining a frozen macroeconomic moment ultimately just like looking at a fossil?
Well, what's fascinating here is that focusing on the specific year completely misses the utility of the exercise.
Really?
Yeah, the exact date of early 2026 is actually irrelevant. The value lies entirely in the foundational logic underneath that snapshot.
Okay, I see.
By exposing an imperfect real-world setup, Scola is essentially giving you permission to build a portfolio based on functional targets rather than unattainable perfection.
Which is a huge relief.
Really is. He categorizes his investments into what he calls his 9 pies, but the real genius is how he groups those pies into deliberate layers designed to interact with different economic weather systems.
Functional targets over theoretical perfection. I like that. Let's look at how he constructs those layers. Instead of just listing off his 9 pies like a table of contents, let's examine the mechanics of his foundation.
Let's do it.
So he starts with what he calls the growth layer. This is the engine of the portfolio, dedicated to long-term expansion.
Right, the heavy lifter.
Exactly. It consists of Pi 1, his global equities core, which carries a massive 42% target, and then Pi 2, emerging markets, targeted at 15% for high growth.
And when we evaluate that growth layer, we are really looking at the primary compounding mechanism. I mean, global equities provide exposure to the largest, most dominant cash-flowing businesses on the
Really
planet.
the big players.
Right. But pairing that with a 15% allocation to emerging markets is a very specific mechanical choice.
It's a pretty big chunk.
It is, because emerging markets offer demographic dividends.
Yeah.
Younger populations, rapid urbanization, and expanding middle class.
All the stuff that drives serious economic expansion.
Exactly. They provide growth rates mature economies mathematically just cannot match. But, and this is a big but, they come with intense volatility, regulatory risks, and currency fluctuations.
So you have this highly aggressive, forward-pushing base representing 57% of his strategy.
Right.
But a portfolio that is purely aggressive is incredibly fragile. To prevent the whole structure from shattering during a market contraction, he counters it immediately with his defensive layer.
And this is where the mechanics get truly interesting. The defensive layer is explicitly engineered for stability during severe downturns. Think of it like the airbags and the brakes in a car.
So what does this all mean? Let's break down the percentages. He spreads this defense across 4 distinct pies. He allocates 10% to global bonds.
Which is pretty standard.
Very standard. But then he does something fascinating. He allocates 13% to consumer staples, 8% to real estate and REITs, and 5% to utilities and energy.
Right, he's using equities for defense.
Exactly. He is leaning heavily into specific equities for his defense, not just traditional fixed income bonds.
And if we connect this to the bigger picture, the specific choices in that defensive layer reveal a deep understanding of behavioral economics. Well, why do consumer staples and utilities sit in a defensive posture alongside something as traditional as a global bond? It essentially comes down to the mechanics of inelastic demand.
Meaning the demand doesn't stretch or shrink based on the economy?
Precisely. Just consider how humans react to a massive economic recession. If liquidity dries up and panic sets in, consumers immediately cut discretionary spending.
Right, we tighten the belts.
Yeah, they delay software upgrades, they cancel international vacations, they hold off on buying a new vehicle, and the growth layer of the portfolio suffers immensely.
Because all those companies lose revenue.
Exactly. But human biology and basic societal function do not pause for a bear market.
Very true.
People still purchase toothpaste, toilet paper, and basic groceries. They still pay their electric and water bills to keep their homes habitable.
Right. You can't just call your utility provider and tell them you aren't paying this month because the emerging markets index had a bad Tuesday.
Exactly the point. So by allocating 13% to consumer staples and 5% to utilities, Scola is mechanically buying into the stubbornness of human necessity.
I love that phrasing. The stubbornness of human necessity.
It's true. When the high beta growth equities are bleeding out in a panic, the cash flows of utility companies and grocery conglomerates remain incredibly robust. They continue pumping out steady, reliable dividends.
So, if we step back and look at the interaction between the growth and defensive layers, this isn't just a static holding pattern.
No, not at all.
It's an active ecosystem.
Yeah.
The defense isn't just sitting there making him feel warm and fuzzy. During a crash, those consumer staple and utility dividends act as an automatic funding mechanism.
Right, they generate cash.
They provide the dry powder required to buy more of the growth equities while they are essentially on clearance.
Yes, it creates a self-sustaining rebalancing loop. It allows him to weather the volatility of those emerging markets because the foundation of daily human routine is subsidizing the risk.
That's brilliant.
And he further reinforces that wall by allocating 8% to real estate. Physical assets that generate consistent rental yield provide yet another uncorrelated stream of income that reacts differently to interest rate changes than standard bonds do.
So he's building multiple distinct walls around his core engine. But even with a diversified defensive perimeter, economic conditions can still devolve into complete chaos.
Oh, absolutely.
The standard business cycle is one thing, but systemic shocks are another. And that brings us to Scola's specialized layers, starting with the hedge layer.
And this layer directly addresses the title of the audiobook itself, The Leaking Pound. Because not all threats to wealth come in the form of a dramatic stock market crash.
Right.
Some threats are silent, and they're very gradual.
Like inflation. He specifically builds the hedge layer to combat inflation and currency crises.
Yeah.
This is Pi 5, which is gold and commodities at a 7% target, and Pi 7, which is inflation bonds at a 6% target. But let's dive into the actual mechanism of that. How do these specific assets plug the leak better than just holding a diversified stock index?
Well, it really comes down to the fundamental nature of fiat currency. Like when a central bank expands the money supply, the purchasing power of each individual unit of currency dilutes.
It leaks.
It leaks. If you hold a traditional bond paying a fixed 4% yield, but inflation suddenly spikes to 8%, you are mathematically locking in a loss of purchasing power every single year.
Wow. Yeah, the numbers in your account might go up, but what those numbers can actually buy in the real world is shrinking.
Right. But inflation-linked bonds contain a mechanical failsafe. Their principal value is directly tethered to a consumer price index.
Oh, so they adjust.
Yes. As the cost of living escalates and the currency leaks, the face value of the bond automatically adjusts upward. You're contractually protected against that specific dilution.
Okay, that makes sense. And what about the commodities?
Commodities function on a similar wavelength. Gold, energy, raw agricultural materials. These possess intrinsic physical utility. When paper currency loses trust, it simply requires a larger quantity of that diluted paper to purchase the same finite physical asset.
Okay, so the hedge layer fights the underlying math of currency debasement. But then we hit my absolute favorite part of his entire structural philosophy.
Oh, I know where you're going.
The optionality layer. This is Pi 9. The category is geopolitics and resources. The role is listed purely as tail risk and optionality, and the target is a remarkably small 4%.
Just 4%.
Just 4%. Now, tail risk generally refers to extreme black swan events.
Yeah, it refers to the absolute far edges of a probability bell curve. Events with a phenomenally low likelihood of occurring, but possessing a catastrophic impact if they do.
So we are talking about sudden global supply chain collapses, unprecedented energy shortages, or geopolitical conflicts that seemingly ignite overnight. But I have to ask, if the event is truly that catastrophic, is a tiny 4% allocation really going to do anything? I mean, it feels like throwing a cup of water on a house fire.
Well, it would be a cup of water if the returns were linear, but the defining characteristic of tail risk optionality is convex return.
Convex returns.
Yeah. We aren't looking for a steady incremental yield here. We are looking for an asset or a derivative that might sit entirely dormant, doing absolutely nothing for 7 years. But in the precise moment, a severe geopolitical shock paralyzes the global system. That specific asset might gap up 300 or 400% in a matter of weeks.
Oh, wow. So the payoff scales exponentially precisely when everything else collapses.
Yes. So while 4% seems minuscule in a vacuum, imagine a scenario where a black swan event slashes the value of your core growth equities by 50%.
Okay, terrifying.
Very. But simultaneously, the tail risk options in Pi 9 multiply by a factor of 5. Suddenly, that tiny 4% slice violently expands to become a massive stabilizing force in the total portfolio.
Providing critical liquidity exactly when the broader market is frozen in terror.
Precisely. By institutionalizing a dedicated 4% to geopolitics and resources, Scola is acknowledging a profound, humbling truth. He cannot predict every crisis?
Nobody can.
Right. He's deliberately leaving space for the unimaginable. His core equities and defensive layers are built for the world as he understands it. Pi 9 is built for the moment his understanding completely breaks down.
Which is the ultimate psychological advantage. I mean, a major reason investors fail to build long-term wealth is that they succumb to panic.
Oh, human nature gets us every time.
It does. If you are terrified of an unpredictable global conflict, the temptation is to liquidate your entire portfolio and hide in cash, which utterly destroys your long-term compounding.
Right.
But if you have a defined, isolated segment of your portfolio explicitly designed to capitalize on that exact crisis, you stay seated.
You do.
You continue executing your regular monthly contributions because your anxiety has been mathematically accounted for.
The structure manages the emotion, which perfectly segues into, honestly, the most controversial revelation of his entire strategy.
Yes, the overlaps.
Yeah, because if you analyze these layers closely, the growth, the defense, the hedge, the optionality, a sharp observer will realize the ingredients are bleeding into each other.
They really are.
He holds small cap funds in multiple pies. He holds similar bond exchange traded funds across both his defensive and hedge layers.
And in the rigid world of academic finance, that level of duplication is viewed as a cardinal sin. A finance professor would grade this portfolio with a red pen and fail it for gross inefficiency.
They absolutely would. Standard theory dictates that every dollar must be flawlessly allocated to maximize return for a specific risk tolerance.
Right.
Overlapping assets means you are paying multiple expense ratios for identical market exposure. It's an unforced error.
But Scola addresses this directly in a section called A Quick Note on Overlaps. He openly acknowledges the duplication. Furthermore, he stresses that these overlaps are completely intentional. He writes, "These are tilts, not accidents. I'm deliberately overweighting certain areas because I believe they will perform differently over time."
Tilts, not accidents. This raises an important question about the tension between theoretical efficiency and human conviction.
Definitely.
Textbooks assume the investor is a rational, emotionless algorithm. But Scola recognizes that true wealth building requires the investor to actually believe in what they own.
Here's where it gets really interesting. Scola utilizes an incredibly relatable, almost defiant analogy to justify his overlaps.
I love this part.
He tells the reader, think of it like ordering 2 desserts because you really, really like dessert.
The audacity of that in a financial context is just brilliant.
It is, and he follows it up with this fantastic bit of self-deprecation. He says, the waiter might raise an eyebrow, but you know what you're doing, probably.
The inclusion of the word probably is just exceptional honesty. The waiter in this analogy represents the entire academic financial establishment looking down their nose at your inefficiency.
Judging your choices.
Exactly.
Yeah.
But what Scholl is articulating is the concept of active ownership.
Right, because if you merely adopt a perfectly efficient passive index strategy just because a white paper told you to, your conviction is incredibly fragile.
Oh, very fragile.
The moment the market drops 20%, you will blame the white paper and abandon the strategy entirely.
But if you intentionally tilt your portfolio, if you deliberately double up on a specific resource sector because you did the research and formulated a personal thesis about global supply chains, you own that decision.
It's yours.
Yeah, the psychological tracking error vanishes. You aren't just passively renting a formula, you are actively managing your capital.
You look the metaphorical waiter directly in the eye and say, yes, I am fully aware that I already have broad emerging market exposure in Pi 2, but I also want this specific regional asset in my optionality layer. Bring me the second dessert.
Make it 2. And that seemingly inefficient choice provides the psychological glue that keeps the entire strategy intact.
That makes perfect sense. A messy, slightly overlapping portfolio that you deeply understand and eagerly contribute to every single month will mathematically crush a theoretically perfect portfolio that you get bored with and abandon after 36 months.
Which brings us consistently back to the foundational habit. Regular monthly contributions, the mechanics of the 9 pies, the layers, the tilts, they all serve one singular purpose.
Right?
They create a psychological environment where Scola feels confident enough to keep buying, month after month, decade after decade, regardless of the macroeconomic weather.
He has constructed an incredibly robust machine. I mean, think about it. The global equities in emerging markets serve as the high horsepower engine to outpace long-term inflation.
Yep.
The consumer staples and utilities form a defensive wall, utilizing the unyielding nature of everyday human habits.
The stubbornness of human necessity.
Right. The inflation bonds provide a mechanical countermeasure to the silent leaking of fiat currency. And that 4% optionality slice stands guard for the truly unprecedented black swan. It is a structure designed for resilience, not just maximum theoretical yield. It proves that personal finance is inherently personal. It has to fit the quirks, the anxieties, and the specific convictions of the person actually funding the accounts.
The architecture must serve the human rather than forcing the human to serve the architecture.
That is a powerful paradigm shift. And as we wrap up this deep dive into Scola's framework, I want to leave you with a final thought to mull over, something that pulls this philosophy out of the brokerage account and applies it directly to the rest of your life.
I like where this is going.
Because your ultimate resources are not simply your finances. Your true wealth is your time, your physical energy, and your daily attention.
The actual currency of your existence.
Exactly. So take a moment and think about how you allocate those personal resources. If your own life's time and energy were divided into pies today, what would your optionality or tail risk slice look like?
That's a great question.
Most of us dedicate nearly 100% of our energy to our core growth engine, which is our primary career, and to our defensive layers. Doing chores, paying bills, maintaining the status quo.
Yeah, we optimize our schedules for absolute efficiency, leaving zero room for overlaps or deviations.
But are you intentionally leaving even 4% of your week, maybe just a handful of hours, completely open to navigate the unexpected?
Just 4%.
Are you dedicating any energy to exploring a wild idea, learning a seemingly impractical skill, or having a conversation with someone entirely outside of your professional circle? Pursuits that seem highly unlikely to yield immediate linear results, but possess a massive exponential upside if they connect.
Most people don't.
No. Or are you operating on a pristine, perfectly optimized blueprint, entirely reliant on your core routine running flawlessly forever, with absolutely no room for the messy, profitable reality of the unexpected?
It might be time to introduce a tilt into your schedule.
Give yourself permission to order the second dessert with your time. Thank you so much for joining us as we explored the mechanics of the leaking pound. We will see you on the next deep dive.